This video is about market bubbles. Now, understanding what a bubble is and how it works is critical to understanding how the stock market works. If you understand market bubbles, you can predict what's going to happen next, and you can sell before the market crashes because you can see it coming. But that, of course, will save you a lot of money and heartache, so it's a very important principle to understand. This video is going to be around 15 to 20 minutes, so I want you to get comfortable, sit back and relax, and let's get started. So what is a bubble? No, not this kind of bubble. That kind of bubble. A market bubble. A market bubble occurs when too much money flows into a particular type of asset. This asset could be just about anything, including stocks, bonds, gold, real estate, art, baseball cards, whatever, you name it. Even antique classic baseball cards. Now, the stock market repeats this over and over, so it pays to know when a market is about to go over the edge and you lose a lot of money. Now, the telltale sign of a stock bubble is that prices are extremely high and they are way out of proportion to where they should be. They are no longer based on fundamental value, and it's pretty obvious because they're extremely high and it just makes no sense at all. The cause of a bubble is that there's too much money in the economy, and this is painful, but a natural mechanism is when the economy wrings out inflation so that prices can return to normal levels. And that's exactly what happens when the bubble bursts, and that's what we're trying to avoid. Now, I'm going to teach you what happened leading up to the Great Depression. There's a reason why we had such a big market crash in 1929. This shows the money supply growing to a huge level, much higher than it should have been in the 1920s. They call it the Roaring Twenties because people were making so much money and they were happy and dancing and jitterbugging and all that. So you can see that right here in 1929 the bubble popped, the market crashed, and the money supply dropped to lower inflation. That's a natural mechanism, and it repeats over and over and over, especially in the stock market. Okay, this increase in money supply caused this to happen. From 1921 at a level of 63 in the Dow Jones Industrial Average, it climbed by six-fold in just 8 years until 1929. That is a big increase for the market overall. Some stocks, no doubt, increased a lot more than six-fold. Now, when the crash finally came, it went down hard in just a few days, and it continued to crash for the next couple years until it went all the way down to 41. So what you're seeing is a lot of extra volatility when the market goes too high to where it should be and then too low. The great crash in stocks saw a loss of 90% in less than 3 years. Now, yes, it did regain about half of that loss in the next 4 years, but little good that did you if you had to sell down here. Now, what should have happened if there wasn't too much money pumped into the economy, the stock market would have gone something like this and climbed more of a straighter line. Instead, you get this huge volatility when the market pumps up too high and then has to correct by going too low. Okay, that's what happened in the 1920s. You'll notice that the stock market recovered pretty well, but the economy still limped along for several years. That's exactly what's happening right now after the housing crash of 2008. Okay, we're in the same sort of situation. Now, this same thing has happened in recent times with a company you've never heard of called Long-Term Capital Management. This was a huge hedge fund that lost a lot of money in 1998. This event actually led up to the great internet bubble of 2000. And here's why. Let me show it to you. Throughout the 90s, with all the increased production based on computers, the market really took off, And most of this was justified. But you see this arrow right here? That's where the market started to sell off. But what happened was long-term capital management needed a bailout. And as a consequence, what happened is the Federal Reserve lowered interest rates when the market was already really strong, basically adding stimulus that caused this extra move up in the stock market, the bubble part right about here. That's all bubble. Okay, that's where internet stocks climbed well beyond where they should have gone over these 2 years. Okay, this is the NASDAQ Composite Index. And so in order to add liquidity to cover the failure of long-term capital management hedge fund, the Federal Reserve pushed prices higher so that we didn't have any sort of financial meltdown. Now, the market got really strong, and then finally things sold off, and we had quite a bubble pop, especially in internet stocks. Now, the whole market in general, the stock market lost about 50%, but NASDAQ stocks and internet stocks lost 70 to 90% over 2000 to 2002. In fact, some went out of business. So that's what's happening. When the market goes too high based on too much stimulus, you're going to have the bubble pop at some point. It's guaranteed. It always happens. Okay? Now, all this is nothing new. Back in the 1600s, this happened in Holland or Denmark. Where was it? Dutch, okay. The Dutch Golden Age, and too much money ended up in tulip bulbs. And this is fascinating reading if you want to read the book Extraordinary Popular Delusions and the Madness of Crowds. I've read it. It's very interesting if you like that sort of thing. It talks about how tulip bulbs, based on today's prices, were worth $500,000 to $1 million. Can you imagine paying that in today's prices for a flower? It's ridiculous, but if too much money is out there, it can end up in some type of asset. At the peak of tulip mania in March 1637, some tulip bulbs were sold for more than 10 times the annual income of a skilled craftsman. Crazy, crazy stuff. So the asset can be tulip bulbs, can be housing like we've recently seen in the pop of the housing bubble. It can also be stocks, and it usually is on a regular basis in stocks. So in fact, this is a key to understanding the stock market. The market falls off in the bear market of 2000 to 2002. The Federal Reserve and the Congress pumps in money. The market goes up. It goes up too high, crashes again. Another 50% loss in stock prices. And here we are again. And the market's going to get pumped up. Now we're a little higher than we were back here, but we've got to be close to some kind of high. I don't know how much higher the market's going to go, but I don't have a lot of faith from an investment point of view that we're going to go too much higher. Okay, for me, I'm selling most of my stocks and have done so already, because I think there's a lot more room to go down than to go up. Okay, so that's what I think. So that's very important for you to understand how this works. Okay, I think there's getting to be too much money in the economy based on the trillion-plus dollars that the Congress and President Obama put in when President Obama first got into office to overcome the financial problems we were having at that time. And you know what? It worked. The market and the economy stabilized. Now, we're still not doing great. It's going to take years more to recover from that, but we're in an okay place right now. And so that's what you need to understand. I just don't think at this point we have a lot higher to go. So that gives you a little bit about bubbles. What are the implications of market bubbles? First, bubbles occur when there's too much money in an economy. Too much stimulus has occurred. The money will flow into some type of asset. All you need to do is identify what that asset is and be prepared to get out fast as soon as the bubble starts to pop. Okay? Bubbles occur when prices become extremely high. It should be completely obvious that they're too high. They're not going to keep going up forever. They've become distorted. They have no relation to value, and you better get out while you can. Earlier is better, but at least be hypersensitive that it's going to pop at some point and be prepared to get out at a moment's notice. Bubbles build up over several years' time. They do not happen soon after the last bubble has popped. Like around 2009, 2010, I heard about people talking about, is this market now in a bubble? Is that? The answer is no. The bubble's already popped in the housing market and for most other markets. So, another bubble's not going to happen for many years to come. At least 3 or 4 or 5 at the very least. This is a natural but painful economic process to remove excess prices and inflation out of the system so it can return to its normal state of stability and equilibrium of low inflation. Inflation is one of the worst things that can possibly happen to an economy. So this is a way that the market naturally gets that out of the system. Okay, I hope you learned something new, and we have so much more to teach you at Market Timing University that will help you make more money in the stock market. We make this knowledge easy for anyone to understand and make more money. And that's what I'm all about, to help you make the market easy to understand and make more money and have a nice retirement. So come to my website, markettiminguniversity.com, and download our free resources. Read from the free blog. Also get your free report, 3 Things Every Investor Must Know to earn greater profits, take less risk, and invest with confidence. This is Greg Kelpack, and I hope you enjoyed this video. Have a great day.